Welcome to the Hirshberg Entrepreneurship Institute's webinar series, Yes, We Can, Perspectives and Strategies for Success in 2021. We'll begin our webinar in about 5 minutes. Thank you for joining us. We'll begin our webinar in about 2 minutes. Thank you for joining us. We'll start our webinar in about 1 minute. Welcome to the Hirshberg Entrepreneurship Institute's webinar series, Yes, We Can, Perspectives and Strategies for Success in 2021. Today, we're presenting Andy Whitman and Paul Richardson to talk about how to successfully pitch for capital funding. We will be, for today.
Lost you, Carlene. Carlene, are you still there? Your sound is off. Okay, well, I will take over from here, folks. I think most of you, it's Gary, most of you have been on. We will be using the regular functions as usual. Keep your chat open. That's how we will be able to share links with you and technical details and so forth. And of course, use the Q&A, please, for questions for the panelists. Carlene, if you can hear me, why don't you, there we go, end that. Okay, good. So if you remember, everybody, a couple weeks ago, I offered to the community that we would start hosting 5-minute offerings at the beginning of each session. And today, We have such an offer from one of our regular attendees, Manoli, you're going to forgive me. I'm going to botch your last name, but Kouloubantis, founder and CEO of Biome Botanica. As Manoli will explain, he has a fantastic company and brand, but he's even prouder, or at least as proud, of his very exciting margin velocity planner tool, which he wants to make available to other founders. And so we're going to take the first 5 minutes to ask Manoli, who's in Wisconsin today, to join us. So Manoli, welcome.
Yes, hi. I'm just going to share my screen. Is it on?
It is on.
Right, and thank you for the opportunity. So on offer, hold on, I just need to realign this. So thanks to the HI team for this opportunity. So on offer is an easy to use tool that allows founders to develop and stress test a pragmatic velocity-based distribution and growth plan, one that is based on solid assumptions and bottom-up economics. In 2019, we developed and tested a highly functional and nutrient-dense cultured food product that targets gut health and immunity support. We had secured placement and we're getting ready to launch in Q1 2020. Unfortunately, COVID impacted the facility where we were going to build our micropilot plant. And so as we gear ourselves to launch later this year, we have decided to monetize one of our own planning tools to help other ongoing expenses. Having spent over 20 years in CPG, in corporates and as an entrepreneur, I founded, built and successfully exited a business. I've also started a business that has failed. If I analyze why, I can point to hubris and the failure to get to grips with the unit economics and margin dynamics of the category that I was playing in. Building a food business is hard. Many will fail. For those that do succeed, there seems to be a skate ramp path, one that requires a slower but very deliberate velocity-based approach. Building an emerging brand is like working with a margin leakage bucket. The industry margin and category dynamics work against you, especially those first few years. Many of us only likely achieve EBITDA positive status within 3 or 4 years only. As founders, we can completely underestimate the extent and timing of these 5 factors. I've done so myself. So the question is, do you really know how those 5 factors will play out, or are you operating on a wing and a prayer? So the planning tool that I'm putting on offer is a tool that we are currently using and is the culmination of 15 years of development arising from advising or due diligence that I've performed or use in my own business endeavors. It is spreadsheet based, but I'm currently appifying it for use in Windows and Mac app and want to make it available to other founders. I will highlight 5 specific features. The Velocity Forecaster allows you to scenario plan a bottom-up realistic approach to velocity growth and related distribution expansion. You can do this in terms of number of stores or the estimated ACV percentage distribution. The pricing and margin matrix, and this is very visual, allows you to prepare and have a numbers-based gross margin discussion with your distributors and retail partners, especially with regards to various consumer price points and wholesale case prices. I still get angry when I see salespeople working out margins on the back of an envelope. The trade marketing estimator allows you to evaluate the impact of price promotions, off-invoice discounts, free fills, and manufacturer chargebacks. More importantly, it allows you to correctly appropriate it so that you can work out the proper gross margins. Still to date, I still wonder at how often people get the gross margin formulations incorrect. The COGS analyzer allows you to determine the COGS range that is needed for a variety of gross margin and trade spend scenarios, and also helps you with co-packing discussions. All this comes together in the cash flow and outlook functionality, which allows you to map and play with a pro forma multi-year EBITDA and net income financial plan, one that is based on bottom-up assumptions. Importantly, the model also estimates working capital and takes into account debt and equity financing implications. It's important to note that this is not a financial tool to go and do your ultimate sort of precision budgeting. The real power of this tool is to allow you to have the tough discussions with your team, with your advisors, and with funders. And it is a limited time special offer for founders who are participating with HEI. Please email me where we can arrange either a group or a single demo session where you might want to know a little bit more about this tool that we are putting on offer. And that's it, Gary.
Wonderful. Wow. Boy, I can't think of a more appropriate offering for than to have this today as we go into finance. That is super cool. If this is a way of saying to everybody, welcome. If you've been following the trajectory of this series, everything that was on Manoli's last slide is what we've been talking about. Anticipating change, being data-driven, being capital efficient, looking at those 5, I love the Death Valley, those 5 buckets, and of course, ultimately leading to cash planning, so that by the time you come and call upon the 2 people who are about to speak to you today, you've got your shit together. So Manoli, thank you. That was great. I hope people will take you up on it. I want to again welcome everybody. Remind you that this series has been co-sponsored by New Hope Network. And again, if you follow the trajectory, we've sort of led you to this place where by now, between meeting a bunch of your customers, your distributors, your retail partners, talking about e-com, talking about capital efficiency, now you're ready to talk to some money people to help you get this going. And we've got a couple of wonderful colleagues and veterans here to speak to us today. Andy Whitman is a consumer products exec and investor who really brings together the experience of a Fortune 100 leader with the passion and resourcefulness of an entrepreneur. He's had successful careers at General Foods and Kraft, but he recognized that nurturing smaller businesses to achieve rapid growth was really his passion. And so he pioneered investing in emerging CPG brands as the founder and managing partner of 2X Consumer Growth Partners, which is the longest tenured emerging brand investor in the industry. And in the interest of full disclosure, besides Andy being a very dear family friend, I'm an investor and an advisor in his fund as well, which is also true of the next guest, Paul Richardson, who's also been focused on impact venture investing for about 20 years as the managing partner of renewable funds in Vancouver, and also, of course, co-managing the venture portfolio of its predecessor, Renewal Partners, which again, I've been fortunate to be part of. And prior to his roles with Renewal, Paul has had a legal career. He's been, he holds degrees in biology and in law, and he's had really significant involvement in environmental initiatives, including leading an international consortium of philanthropic foundations and private investors in successful negotiations over a couple-year period with the federal and provincial governments and the coastal First Nations to structure the financing for the conservation of the Great Bear Rainforest, which I'm sure many of you know is the largest intact coastal temperate rainforest left in the world. He's been involved as a board member in many nonprofits and firms. Paul and I have served on a couple of boards together. We serve on Uncle Matt's Organic today. And he's been, again, a good friend and a very active participant with HEI and in our sector. Now, as usual, before we begin, and I should, of course, say everybody knows Elliot by now. Elliot will be my co-moderator. He's presented, he's moderated, he's come through COVID and back, and we're delighted to have you here as well, Elliot. So before we begin, as you know, we always ask our panelists to solicit a couple of poll questions, which we're gonna put up right now. Carlene, if you can go ahead and do that. And I'd ask everybody to please right away take a moment. There's 4 questions here that Carlene will post. And if you could please give us your answers, it will help us to direct our comments today. So the first question, have you pitched for funding before? Simple yes or no will do. Secondly, regarding raising capital, please check all three. You've either previously raised capital, you're currently raising capital, and you'll likely raise capital in the next 12 months. And if it were me back in the early days, I would have been checking all three boxes. If you are currently or likely raising capital in the next 12 months, how much? The guys would like to have a sense of what your ballpark is. And then finally, where did you begin your career? Was it in marketing or sales or finance or ops or other? So go ahead and respond. And Carlene, you are seeing the results, so I'll leave it to you to switch out of the polling when you're, or maybe you're off mute now. You can tell us when people have 10 seconds left.
Well, we have we've got about half of us have voted, so if we can still have more of our audience vote, that would be really great.
Okay, let's, we've got about 150 of us here, so let's give it another 10 seconds. Okay, Carlene, let's see what we got. All right, so about 2/3 have pitched for funding. Wow, a solid third. Congratulations to all of you have not pitched for funding. I'm jealous. Regarding raising capital, you can see half again or so, a little bit more have previous, about 1/3 are currently raising, and 2/3 are likely to raise capital in the next 12 months. We have about a bit less than half of us looking for less than $1 million. That's actually really interesting. And about 1/3 looking for up to 3 million or so. And you can see the other numbers. So not a lot of big raises going on here. And finally, nice distribution here with other rivaling sales as the lead sources. So very informative and helpful. Thank you all for filling in. And so with that, let me turn it to my friend, Andy Whitman.
Thank you, Gary. Let me just share my screen. All right, can everybody see that?
We're good.
Great. So Paul and I are thrilled to be here. We've known each other through the years. I think we met initially through Gary, which probably, like the rest of the world, he's the connective tissue. As Gary mentioned, I've now been doing this for 20 years and am thrilled to be a great partner in the emerging brand ecosystem. Not a commercial for our firm, but this will be here for you to have as a reference. We're strictly focused on consumer products, not services, restaurants, retail, and just in sort of 5 simple non-durable verticals: food, beverage, personal care and beauty, home care, and then pet. So that's sort of what we do. A typical company is, 2 or 5 or 10 million, and maybe as much as 25 million when we participate. So I'll turn it over to Paul.
Great, and you can switch to the next one. We don't need to talk about me. That's great, thanks. So yeah, Renewal's been around for quite a while, and on the CPG front, I'm happy to say that I have 3 wonderful partners who focus entirely on that within our team. And so if you're looking to get in touch with us, getting in touch with Genevieve, Kate, or Jared is really the way to go. On the CPG side, we focus on organics. We're focused on carbon reduction, so solutions that don't require a lot of packaging, that aren't shipping a lot of water around, that sort of thing. We do a variety of different deals, from fairly quick deals, as Gary will know, to deals where we take 5 years to get to know the people. So a huge range, and really I am fortunate to work with a great group of people, and so hope that you can go to our website and check out Jen, Kate, or Jared for CPG. In terms of amounts, we tend to be at the larger size. Our current fund is a $145 million fund, and so we're trying to make investments of 3 to 6 million if we can as an initial investment, just to give you a sense of what we're looking for. So, thanks a lot. Back to you, Andy.
Great. And it should be very noteworthy to the group that there is a surprisingly small number of female investors in this industry, which is sort of surprising given that CPG is still a substantial portion of the consumer purchase base is female. And Paul and his team are amazing on that front. And I'm privileged to have 2 other female partners, so 2 of our 3 partners, and 60% of our full team are women. So I think of the women, the high profile women in the emerging brand space, a lot of them are in these firms, and we're proud of that. So real quickly, this is what we're going to do. We're going to tackle sort of 3 topics. Paul and I are going to tag team on them. I'm going to do a couple minutes on basics of pitching. Paul is going to do sort of a 2-parter on considerations for a funding partner. And then sort of an important discussion on structure versus valuation, because many people think it's all about valuation. And then I'm going to do a little bit of a segment on 10 reasons investors pass, which we think is really important to learn from that. And importantly, how does it help you to be successful? Then Gary and Elliot will lead a discussion with this group, and then we'll take some questions. If we haven't said it 100 times, your questions go at the bottom of the screen in the Q&A button and not in the chat. So with that said, Gary, anything else before I go?
You're on.
All right. So, when you think about the basics of pitching, be clear on what you're looking for. If you're looking for just money, that's okay. Be clear about that. If you're really looking for help, be clear about that, because it's really clear to us when you're not clear. And it's really clear to us when you say one thing, but you really mean another thing. So be clear on what you're looking for. It'll help you to find it. Tell your story. There's something, I hope, really special and different about your business. And hopefully you can tell that story and tell it succinctly. Remember, you're talking to people that may or may not understand your industry. They may or may not understand your acronyms. So think about it in the way that you would explain this if you have a teenager that's not from the industry or a parent that's not from the industry. Sort of keep it simple, not talk down to people, but just sort of keep it simple. Try and keep the jargon out. This is not about the numbers. It's about the story and a reason to believe. I mean, that's an important phrase, reason to believe. Whether people are investing in a pre-revenue business, a business that's emerging and looking for $250,000 or somebody that's looking for $50 million, it's all about a reason to believe from the investors. Why are your business interesting? Why are you and your team the people that can pull this off? And everybody's got to be clear. There's always risks. So how are you ahead of thinking about that? I think it's important to think about this as a concise PowerPoint. Please don't do really long word files. Keep it simple. If there's an important visual and a few bullets, that's a hell of a lot more impactful than 30 pages of 7-point type. Keep it simple. You'll see in a minute. I'm a big Guy Kawasaki fan. I think he has a simple principle. He's a tech investor in Silicon Valley. Use your visual media, videos, photos, charts. Make your points. And you should have a 1-page executive summary. Many people will say, a couple pages is fine. I sort of subscribe to, if you can't say it in 1 page, you need to work a little harder. On our website, you can see a visual of it. We liberally borrowed and then made some adjustments from a 1-pager from the Angel Capital Association. They did a really cute 1-page executive summary, which is essentially the business plan for the wheel. 2 caveman, it's very cute. And we did some minor modifications for things you should think about in CPG. So there's a 1-page example. And then the second page gives a few comments of what you put in this section and what you put in that section. So I'd encourage you to think about a 1-page executive summary and always have your Excel model built from the bottoms up. Please don't do, there's 1 billion people in China. If we only get 3.5%, it's going to be a big damn business. That's not way to do it. Think about it as, you got a bunch of tabs. here's your revenue growth, and it's driven by number of doors times number of cases per flavor, per store, per week, plus your online. Here's what you're getting from this from Thrive, from Amazon. This is our AOV, et cetera. So build it from the bottoms up, and please don't PDF Excel. That drives people nuts. So with that said, remember, in your first meeting, the goal is not to tell people everything. The goal is to tell them enough that they want to hear the really detailed stuff. So be careful about telling too much, be careful about telling too little. So it's a delicate balance. Again, Guy Kawasaki talks about the rule of 10, 20, 30. 10 slides, 20 minutes, and no smaller than 30-point type for the old people in the room that can't see small type. And Gary snickering, yes. So I resemble that remark. So with that said, these are Guy's point of view on what the 10 slides are. This is really more of a sort of tech investor, but I think you'll take away, and all these slides will be available. Carlene will post them to the website. So, you know, you don't have to write furiously. So with that said, you know, think about how COVID has impacted your business, because in what I'm sort of referring to as the next normal, I didn't create that phrase. That's the CEO of Saks talked about the fact that we're going to be in a current situation and there's going to be an evolution for 6 or 12 months, and that's the next normal, and then there's going to be a next normal after that, and we may have several next normals. Everybody that's listening to your pitch is thinking about how have you been impacted by COVID? What does it mean for me as a prospective investor? So you got to address it head on. My hope, and I think all of our hopes, is you came out of this being a stronger, better business than you went into it, which I know sounds weird, but maybe you jettisoned the SKUs that you probably should have jettisoned anyway. And if you had, unfortunately, one underperforming person, you know, they're not with you anymore, and you optimize your cash and you optimize your supply chain and, you know, a bunch of other things, and you come out as a better, more focused business, even if it's been a little bit painful. So make sure your business model and growth plans reflect the world we're in. If your business was all about selling to gyms, and 17% of fitness centers, gyms, you know, 24-hour fitness, Equinox, whatever, they closed. 17% of them closed. So everybody that's in that space knows it. And if you haven't thought about how you pivot, it's going to be a discussion point. So just think about how your business is different than it was a year ago. Emphasize the actions you take, and because you're going to get credit for that. And importantly, how you come out on the back end. And think about the important metrics. Overall, what are they in brick and mortar? And I was unbelievably impressed by our friend's 5-minute pitch up front. Anybody that knows me knows how I am a believer in velocity and gross margin and a number of other stuff. Elliot's nodding along. I think that kind of stuff is really interesting. And while Gary is one of the high-profile entrepreneurs that regularly talks about all the mistakes he made, and some of them twice, most entrepreneurs don't. So I think it's to be accomplished that he, and if you know Aaron Felber, he's been very open about what went wrong in his business, and a few others, and we could all learn from them. So make sure you get your metrics right, demonstrate your ability to succeed, and cash. So that's the upfront. Again, if you have questions, put them in the Q&A, and I'm now going to turn it over to Paul for a few minutes on the next topic.
Great. Thanks, Andy. So part of what we thought about was, you know, when people think about pitching, they generally think about trying to get money. But really the relationship with the people that you're trying to get money with, from who they are, how they can help you, and how you structure your deal with them, in my mind, is all three things are needed to make a successful pitch. You have to have identified the right partner, and you have to have identified the right way of doing business together, as in addition to identifying the amount of money that you need and how you're going to use it. And so this little portion of it will be a little bit about that. So from my perspective, one of the most important things for us, both in terms of companies that pitch to us and co-investors with us, is whether or not there's a mission fit. Do we all think that the product and what we're doing the same way? And so do I think that I'm investing in an organic company, but my co-investor thinks there's a huge opportunity to transition to conventional, for example, or vice versa. So make sure that you've got a mission fit with whoever you're preparing to do business, because if you don't, it will cause trouble down the line. And we've generally had more trouble on that front with co-investors than with companies that we've invested in, but it can happen both ways. The second thing is make sure that you're getting the right type of partner for the stage that you're at. And so what I mean by that is that some partners, investors like to come in and really help a company and really get their hands dirty and get involved and have weekly calls with the entire team and dig into the financials. And that's good for some companies. Some companies need that, but that's really bad for some other companies. And so if you're up and going and you have a decent team and you're looking for a partner who will be more about introductions, getting a good board together, that's one investor. A second investor is the other person who's willing to dig in. But if you're a person who wants to run a business, like we have a wonderfully running business right now, and we're looking for a new investor to come in and put $10 million in, and they would be a minority investor. And they said to the CEO, who's a super competent CEO, we'll only want a once a week 3-hour call. And I was just like, 3 hours every week, just talking to a minority investor? That's not on the cards. And so finding those things out early is really important. Yeah, and also thinking about what they can bring to the table. And so in the early years of Renewal, we would get involved in companies and have to dive in and help them with their financial models and things. And so Kate and Jared and Jordan have all rebuilt financial models. We've now decided that's really not our core strength. And although they can do it, we don't want them spending all their time doing that. So make sure that either, that the new Renewal would not be a good partner for some of those early companies where we had to dive in. So check that sort of thing. The next thing to check really is the time horizon. And so if you're thinking that it's going to take you 5 to 10 years to properly build your business before you can sell it, make sure that you don't have an investor who's going to be anxious to try and force you to sell your company before that. Capacity to follow on. So it's hard to get investors. It's once you've got someone in your fold and you're doing your job, it's much easier to keep them. And so to get your existing investors to follow on. And so, you should check with your investors whether or not they are reserving money for follow on. And if so, whether that aligns with your needs in the future. And then the final thing I really encourage people to do is to do reference checks on their investors. And so your investors are going to be doing reference checks on you. You're starting a long-term relationship. There is absolutely no reason why you shouldn't be able to do proper reference checks on them. And so I appreciate it when and you don't do them at the outset. You do it once you're sort of looking like there's going to be a marriage here. But at that stage, it's really important that you do proper reference checks, and they'll be doing them on you. My suggestion is that you're open with them, ask whether they have any issue with you contacting any of their former companies for references. And my suggestion is that you not just look at their current companies, you look at companies that they've exited as well, because those are the companies that they'll have gone through a whole life cycle with the investor. And no investor is going to be perfect, but finding out what you're getting into before signing any papers for any money is really important. And so, from my perspective, I think it shows a smart entrepreneur when they ask me for whether they can do references. I'm certainly not insulted. On to the next one, maybe. Yeah. So the next thing is what's the right amount of money to raise? And the trick, the easy answer is raise as much as you can, but that's not always the right answer. But you should raise enough so that you can get through to a significant rise in value before you need to raise again. Because a lot of people don't think about what the investor's expectations will be on a rise in value from the post-money valuation of your deal. And so you have to add whatever money you're raising to your pre-money, and then factor in a reasonable return for an investor over the timeline that you anticipate. And so and too many people don't necessarily do that, but your investors are certainly going to be doing that sort of calculation when they're deciding whether or not it makes sense for them to get involved. So ideally, think about raising enough that it will take you through whatever milestone you have to get through, whether that's introducing a new product, whether that's getting a large new retailer on board and up to speed, whatever it may be. Make sure that you get enough to get yourself through that. The next thing to
Paul?
do, yeah.
No, unmute, Andy. You're still muted. There you go.
All right. Raphael asked, what's a significant raise in value if you were to quantify? Since you just talked about that, I thought I'd throw that question over.
Sure. So from my perspective, if someone's, I'll just give you an example. So if someone's raising at a valuation of $10 million and the post money's 15, and they want to, they expect it to last a year and a half, I would expect that in my mind, that investment has to go up to around a 25, because there's going to be bumps in the road to bring that down. And so, at a high level, those are the ratios that I would think of. And if I think that it's going to go up from 15 to 20, that may be an okay return for us, but it doesn't factor in the risk of things going bump in the night, in my mind. So,
Great. All right,
I'm curious, what would your response be to that too? Is that about right, or do you have thoughts?
Yeah, I think that's fair. The biggest thing is in CPG, there's less rounds than in tech. So in tech, they want to see huge step ups. In consumer products, if you raise, $2 million for, so maybe you do $500,000 for friends and family, and then you maybe raise 2 or 3, and then maybe you raise 5 or 10. That may be it. So there may not be Series F. So in some ways, it's a little bit less relevant if you don't have a whole series of raises. If you have a lot of raises, the bigger thing for me is capital efficiency. If you raise $10 million and add $3 million of revenue, I'm not that interested. If you raise $3 million and you add $20 million in revenue, I'm really interested.
Yeah. Can I just, since we're interrupting the flow, this is really an important dialogue, and I just want to underscore something that you've both said, which is, most, and Elliot and I have had this conversation with entrepreneurs 100 times. A lot of entrepreneurs are excessively worried about dilution, putting it as at a way high up on the pyramid. And I'm not saying dilution isn't important, but being diluted, or rather, to put it more bluntly, having a smaller piece of a successful pie is a whole lot more important than having a large piece of an unsuccessful pie. And so what you're both really saying, in my simple way of thinking about it, is don't cut yourself short here. Either raise enough capital, to Paul's, the first point in front, or be sure that you're not holding out for perfection in the partnership, because you're better off taking it, closing, and moving on. then, putting yourself at risk.
It's a perfect lead into the next thing, which is valuation, in terms of what you, and so many people are worried about their dilution, that and reading the paper and reading what's happening in the public markets, and come to us with absolutely unrealistic valuations. And so it's really important to be grounded in that, and to be grounded in your plan making sense for the valuation that you're asking for. And so, if you look on the public markets right now, I could point out a organic beverage company that's at 20 million in sales, that's trading at a $500 million valuation. That's just silly. There is, so many things will have to happen right for that company to ever be worth 500 million. And so, and if you are going for a gung-ho valuation, you will set a business plan with potentially unrealistic numbers in it. And if you do that, you're forgetting what I think is the cardinal rule of both sides of this equation, is that we're getting into a long-term relationship with each other. And I'm coming in trusting you as an entrepreneur, trusting you that you know your numbers. Of course, we dig into them a lot, but at the end of the day, they're still your numbers. And your numbers have to be grounded in reality. And if they are grounded in reality and you're fair about valuation, you'll find a partner. And if they're not grounded in reality, you may find a partner, but then when the next round comes along, that partner won't want to have anything to do with you. And when you go to new investors, those new investors will say to you, can we see the plan that you gave to your investors last time, if they're smart new investors, and take a look at it and say, no, you misled these people the last time. I don't really want to get involved with you. And so my key thing in all of this is, these are relationships that you want to have last for years, through the time that you're involved with each other and thereafter. And so being realistic about your valuation and being honest and fair about your numbers is incredibly important.
Paul, if I may, just because I'd love to get your read on this. One of the things, I think it's a balancing act, and Gary and I have talked a lot about this, as have Andy and I, about the concern of founders, especially early, so much on their own personal dilution. The thing that I think is missed, and I'd love it to hear it from both of your perspectives, is that you also have to provide the investor with an understanding of how they're going to make money. That you need to have that kind of mindset, that it's on one side of the fulcrum is managing and limiting your dilution. On the other is making sure that you're setting your investor up to win, to benefit from the risk that they're taking and the support that they're giving. And I just think that oftentimes that end of the scale is not something that many founders bring to and have a discussion around with potential investors. So just thoughts on that.
Yeah, I agree entirely that it's a very delicate balancing act. One of the things that we try to do when we get involved with a company and there's this strain over how they're going to benefit and how we're going to benefit and how the rest of the team benefits, is we try, you can put some of that back into the founders' pockets in terms of participation in options and things if things go well. And what we like to see is founders who really are about having that growth in the company go to all of the individuals at the company. And so often we'll have an early discussion with somebody about what their plans would be in terms of options. And it's always interesting to see how much they'd like for themselves and how much they'd like for their team, who don't necessarily have the big chunk of the company to begin with. And for us, it's, for me, at least internally, it's one of sort of those signs about whether or not they're going to be great people to get involved with. We have gone in, so we've had a number of conversations with people where we've gone into founder-owned companies and talked to them about creating an option package for their entire team. Generally, the response from true mission people is, that's great. Do you have any precedents that we can look at to sort of think about it? And for us, for me personally, that's a huge sign in terms of positive energy momentum towards getting this deal done. I mean, Gary and I were involved in a company where there were over 200 employees, most of whom were on the manufacturing floor, who'd never had options before, and that happened, and there was a nice exit. And it's really one of the nicest things about being involved in business, to know that that sort of thing flows through to everybody. So I think there's creative ways you can bridge the gap, but it's just about nobody being too greedy themselves, both in terms of what they're demanding for as an investor, or the amount of the company they think they should keep as a founder.
And in the interest of time, I'll just add one little thought, which is, if you're going to pitch to a retailer, you ought to be doing the profit per linear foot or category profitability from their perspective, so you understand what you're offering them. I'd say the same thing applies here. You're not selling a product, you're selling an investment, and understand how the other person will look at it, and is the return interesting? And you have to assume that there's going to be bumps along the road, and everything doesn't go perfect, and it probably takes more capital than you'd wish, and just look at it from their perspective. So with that, Paul, do you want to go on?
If you're 5'7" tall, what's the profit per foot? I'm joking. Keep going.
Yeah. So looking at it from each other's perspective sort of carries on to my next thing, which is some control considerations. So actually not quite, well, this is fine. And that is, I don't believe that there's ever sort of a cookie cutter way of engaging with each other. Each company and each situation is somewhat different. And so, if we're investing with a consortium of other funds, and the funds collectively are a majority of the company, and everybody knows that the company is going to be sold in a while, that sort of dictates one set of terms. If we're coming in as a smallish minority investor in a founder-owned and controlled company, that dictates another set of considerations. And in that second set of considerations, we may ask for things that seem unreasonable, like limitations on salaries, for example, or sign off on salaries. But sometimes people get quite annoyed about the idea of an investor coming in and telling them what they can be paid. But it's just all part of what Andy mentioned, like putting yourself into the other person's shoes, where we're coming in, and if we don't control the company and the founders do, and they decide one year that they're going to raise their salaries from 200,000 to $1 million each, that's pretty material for us. And so on all of this to say is, I think that while you're finding the right partner, asking questions, diving into things like control, seeing whether or not their approach to all of these things fits with your approach is incredibly important. And then the final thing I'll say on this is, too many young companies that we see don't have good legal advice. And so make sure that while you're going through this, you have somebody helping you structure deals, because we sort of have to sometimes have our lawyers look out for the founders, which should not be happening in these negotiations, and other people may not do that. And so I do think not skimping on your own legal advice as you go through this is incredibly important. So
And to that point, this is not a contracts attorney. This is definitely not your will attorney. This is somebody that understands growth capital, ideally growth capital in our industry, because it's different than tech, but this is a specific expertise. And securities laws are different than just a contract. And yes, an investment is a contract, but make sure you're getting people. And by the way, if you don't think you have good people, ask around. I'd be glad to give you a few recommendations. Paul would give a bunch of recommendations. I'd never give you one name, but I'd give you a few people that, you know, would be worth talking to.
So then the next slide is just an illustration of something that we bump into a lot of times. And so if you, and this is structuring your investment as a straightforward investment, or as what many venture firms like to do, is what's called a participating preferred with an accumulating dividend. And from a renewal perspective, my own strong preference is to try to have as many people in a similar class of shares as possible. Because if you have multiple different layers of shares with multiple different rights, it becomes very, it's complicating to the company in the long run. And we often run into people who are talking to a fund and have been told that their valuation should be X. And we think X is a little bit rich. And the fund that's going to be investing in them is offering a participating preferred with a 8% dividend or something of the like. And we say, well, we would do a more basic investment where we've got some shareholder protections and downside protection, but not the rest of the bells and whistles at a lower valuation. And you would be surprised how often that does not resonate. And for me, it's super frustrating, because if you just do the math, it should. And so this is a little illustration, but you should work it through in all of your cases where someone's valued their company at $10 million versus $12.5 million with a participating preferred. And so
Paul,
yeah.
maybe for those listening, you can just give a quick definition of participating preferred, because I think there'll be some questions coming in on that.
Yeah, so it basically means that the investor gets their full investment back plus their accrued dividend, and then off the top, and then fully participates in the value of the company after that. And so if you've got, in this scenario that's on here, and I invested $2.5 million, and we sold the company at for $20 million, I would get my $2.5 million back, plus the accrued dividend. So it would depend how long we've owned the company together. So call it, I'd get $3 or $4 million off the top, and then I'd still get my full ownership stake of the company out of the remainder. And so it works out okay for you if you have a huge home run. But the interesting thing, if you look at this scenario, you know, you've gotten a significantly higher valuation to start with. But if you sell in 5 years, even if you sell the company for $50 million, which is a home run in anybody's books, you're still not doing as well as you would have done if you'd just done a straight deal for the lower valuation. And so, we've had companies where we've said, so we had one of our early investments, we got involved with a company where there was a participating preferred already in place, and we came in as an investor into that round. The company did well over time. We got an exit. I ended up being the chair of the company at the time that we got the exit. And the founders who'd created all this value and the workers who'd created all this value were going to be getting a inordinately small amount of the company. And so I had to try and dive in and renegotiate the terms and get all of the early investors to do something that was more fair, which was very difficult to do. And so I totally urge you to think about these things over valuation. While you're doing your
Overvaluation and over complexity.
yeah. Anyway, okay, so that's just a little bit. Sorry, I've probably gone on too long, but a little bit about who you should get in bed with and how you should structure things.
No, this is really important, Paul. And as you and I were talking about this for the benefit of the group, we thought this was an important point to make because unfortunately, if we were sitting at the Starbucks in University Avenue in Palo Alto, the bike messengers could explain to you about liquidation provisions and anti-dilution protection and participating preferred. And unfortunately, in CPG land, that is not generally something people spend time on. It's all about valuation / dilution because that's two sides of the same coin. And the analogy I often use is there's a bit of a balloon here. If you and a prospective investor are talking and you squeeze the balloon on valuation, one of two things happens. The balloon pops and you're done, or the air goes somewhere else. Maybe the air goes to preference. Maybe the air goes to coupon. Maybe the air goes somewhere else, but it's going to go somewhere else, just the way the principle works of a balloon. So I would much rather have a very simple structure, but as entrepreneurs sometimes want the high end of a range of valuation, sometimes you can't get to the return Paul or I would be looking and needing without some of those bells and whistles. So while I prefer not to have it, I have those structures in a bunch of companies because it's the way we got to something that made sense. So with that said, I'm going to now move on to an abbreviated 10 reasons investors pass. A couple notes. There is a dedicated 45 minutes or an hour on this topic on the 2X Partners website. So feel free to look at that. You'll also get the slides. But we thought it was important, in the world of dating or job employment, people don't tell you exactly why, in dating, it's not you, it's me. No, let's be clear, it was you. So, they talk about that. In this world, people don't say no, they say not now. Well, not now doesn't give you any insight for real. So we spent a bunch of time and a little bit of money, but a lot of time over the last 15 years. We've updated this a couple of times on why investors pass. And hopefully, other than getting some ideas of, oh, I better not do that, hopefully this generally helps to make you more successful in your raise. So I'm going to do this quickly. I'm going to do it in the context of some analogies. But all right, so 10 reasons. Number one, dazed and confused. I was looking at something I got recently, a 90-page, I'm just looking down at the notes I had on this document, 90-page document, greater than 40,000 words. And according to Google, if you Google, that would take me 2.2 hours to read. There is zero chance I'm going to spend 2.2 hours reading something before a first meeting. Just isn't going to happen. So tell your story concisely, keep it simple. Again, we talked about the one-page executive summary. If you can't tell your story in 10 to 20 PowerPoint slides, don't do Word with tons of small type. But if you can't tell your story in 10 to 20 slides, you need to work on your story. But this will help you to be more successful. Second, wrong way. There are plenty of investors out there. And if you're talking to me, I'm a nice guy most of the time, but I'm not going to write you a $100 million check. I'm also not going to write you a $100,000 check because neither of those fit my charter. So make sure you're talking to the people that do what you need at the moment. Look, if you want to talk, if you're raising $150,000 or $500,000, that isn't something Paul or I are probably going to do. You should get to know both of us, but not when you're in the middle of a capital raise. Your time is the most valuable thing you have. You need to talk to people that do what you're doing and meet us when you're not fundraising, because you're always fundraising informally. So meet us in advance. There's nothing better than tracking a company several times over several years. It's much better than, boom, here's the presentation, where's my check? Because that doesn't really happen. So make sure you're talking to the right folks. All sizzle, no steak. Part of the reason we did the poll on where did you start in your career is about 40% of the people were marketing and sales combined. I was one of those. We are the worst offenders. We tell you all about the amazing product and show you our social media, but we forget to tell you about margin structure or how it's made, or the fact that there's, complexities of the raw material purchasing. Remember, you're not selling this product to a consumer, telling them why they should buy it. You're not selling this to Whole Foods or Kroger for distribution. You're selling securities. You're selling an investment. So remember, think about it in terms of it's got to have some steak, not just the sizzle. And that's data. Again, you don't have to have everything, but back to the comment I made a few minutes ago, it's about the reason to believe. SPINS data, IRI data, your Amazon sell-through data, whatever it is, be specific and show your reason to believe. Leaky buckets. I think it was last week, maybe it was the week before, we were looking at a really interesting $5 million revenue business that believed they were going to go, that was last year, believed they were going to go to 12 this year. Okay. That growth rate is actually considerably lower percentage-wise than the growth rate they've had 2 years in a row. So again, you're not betting on, 200%, or in this case, 140% growth, where they've never done more than 10% because all of a sudden they had money. This business has grown 200 or 300% a year for 2 years. So again, that sounds interesting. And when you peel back the onion a little bit, what you learn is 80% of the growth is on the products they've got. And 20% is on stuff they haven't even dreamed up yet. But they have a leaky bucket because their existing business is declining. So you can only cover that up with new distribution for a while. And this relates to this point and one I'm going to share in a moment. So you're much better off with 100 doors that are on fire than 1,000 or 10,000 doors that are struggling. We talk a lot about gross margin. There was an entrepreneur in the beverage business that showed me his 22% gross margin, which I tried not to throw up on, and talked about how it was going to get to 52% in 2 calendar years. And I politely stepped on the bullshit button and said, I don't believe it. I mean, we had become friends over 2 years, and I said, I don't think this is realistic. I don't think you're going to get there. So don't do it for my benefit. Do it for yours. Do it to understand how are you going to get there, because his answer to everything was scale. Yeah, you'll get a little bit from scale, but I encouraged him to go off and do an exercise. How are you going to get to 50? What specifically are you going to do? You're going to get a penny a pound on sweetener at this volume. You're going to get 0.5 cents a can at this volume. And he came back to me about 4 months later and said, boy, I never get into the 30s. I said, well, what are you going to do about it? He said, well, we're going to go off and try and figure it out. I said, well, all right, here's 5 ideas that you might chase. And you need to think about it and make the list of what decisions would you have to make to get to 50, knowing that you'll never make all of those decisions. One of them is raise price a whole bunch. Anyway, long story short, he did that exercise and said, I think I can get to 35 in 12 months if I do these 3 things. And I think I can get into the 40s if I do these 5 other things. And some of them were really simple. If you don't know how many colors are on your package, ask your printer. My guess is there's a lot more colors than you think. And once you get beyond 5 colors, or maybe 6, depending on the printing process, each color is irrationally expensive. And most of the naked eye can't tell the difference.
Andy,
It's design process.
sorry, we got a ton of questions. We got about 3 minutes max to get through the next 5.
Got it. No, not thy business. I do not expect you to be a CFO. But I do expect you to know your business enough to talk about basic things like, what your financials were last year, what they are this year, what your break-even point is. If somebody wanted to go faster, what would you do with an extra $1 million? Basic stuff. Things like, I'm not so good with money, which somebody actually said to me, which made me, the bubble over my head was like, and you want mine? That doesn't ooze confidence, which gets to some other topics. We talked about betting on the come. Investors are always going to be more comfortable with stepping on the gas on what's working versus new stuff. But we also understand there's a mix. If it's 70 or 80% step on the gas on what's working, nobody's going to give you an issue. If it's 20% of what's working today and the rest is all new stuff, you're going to get some challenges. Mismatched returns. Every investor is different, but I can tell you no institutional investor is interested in a 10% annualized return. That leads you to losing your job. So with that said, make sure you're matching your return potential with whoever you're talking to. And there's some angels that expect massive return and some angels that just want to beat the market because it's fun. Understand what their expectations are. Failure of confidence. This is where, if you're sitting here on March 17th, and you tell me you're going to do $1.5 million for the month of March and you do 750, we got a problem. You should know what you're going to do for March as you're sitting here on the 17th, within a room of wiggling. You should have a pretty decent idea of how April's going to shape up. If we're talking on October 15th, you should know how your year's going to shape up. You should know if you have supply constraints coming around the corner. It's all about exuding confidence. And, we may be one of the very few people that have looked at over 1,000 businesses more than 3 times. And there's literally one business in that 1,000 that did exactly what they said each time. And it's not because, to Elliot's question, people are trying to BS me. It's because shit happens. So, you need to give people a reason to be confident. And lastly, there are lots of messy companies and there are lots of messy deals. We can help clean up messes. We can help improve companies. But if it starts out really bad, some people will just walk away. So with that said, there are some resources on 2xpartners.com. Feel free to check those out. And, I know Paul and I would be glad to take some questions from the group.
Yeah, no, we're going to get to them. Thank you, guys. It was dense, and this is why we record these sessions, because there's actually a fire hose here. Let me say quickly, because it is in a couple of questions before Elliot goes. This session was intentionally structured to be about institutional, friendly, what I'll call friendly institutional money that is has a reason to be in this space that most of us are in. It was intentionally not about friends and family. And I know a number of the questions we're asking. And so I just want to quickly say, friends and family money, for those who ask these questions, it's essential. I know Andy and Paul will back me in this. They want to see that you got your Aunt Sadie and your mom and your brother and sister in there before, that's confidence for them. It's security for them. It also is shows that you have dealt with the issue that Paul underscored, and Andy did too, which is this is really a relationship. And so if you're doing it with family, this relationship. Also, I would just say quickly about friends and family, keep it simple. I mean, for God's sakes, these are lifelong relationships. Paul has said to you, you got to think about these guys as a relationship. So, but you certainly are going to be living with your F and Fs. So again, we might do a different session on friends and family at some point, but this is intentionally for the kind of parameters that they laid out at the beginning. So Elliot, why don't you go ahead? Got a lot of questions in. You good, Elliot?
I'm good, Gary. Sorry, couldn't get it off mute. All right, Andy, Paul, you ready? We're going to rapid fire this thing. I'm just going to make one comment. Andy, you were talking about gross margin and how so many people say scale is going to be the elixir to all margin ills. The one thing that people often forget is that usually scale also means price compression. So you might get your COGS down, but your price is going to go down probably as much, if not more. Okay, tons of questions, rapid fire. I'm going to start with Andy's question here, and I'll give it to you, Andy. Could I ever partner with an investor who would install a suitably experienced CEO that they appoint, leaving me to focus on the things I'm good at, i.e. product development and developing marketing assets, et cetera? And I'm just going to add one caveat to that is how do you have that conversation with an investor without, seemingly labeling yourself as incapable, right?
No, I mean, I view it as a sign of strength because you know what you're good at and you know where you need help. So, there's a business we have the privilege of being involved in called Good Karma, where there was an unbelievably seasoned CEO that was very self-aware, saying, I know more about fluid milk, or in this case, non-dairy fluid milk, than almost anybody in the country. But I'm a private label and supply chain guy. I'm not a branded products guy. So the next stage of the company's growth, the right thing is somebody with that background. And we together identified some great candidates, which we were very fortunate that all three of them were interested in it. And Doug Rady joined at the investment. Doug is the CEO of Good Karma today. And it's a great example. But this is all about being honest with your prospective investor. What are you good at? Unfortunately, too many people see tech world where it's all about, the ego of being CEO of a big company. There are plenty of examples of people that are brilliant in a role other than CEO. So don't be bashful, but bring it up in the context of this is what we're looking to achieve.
Yeah, your job as an entrepreneur is to do whatever you need to do to build value in the business, and that includes bringing somebody in who can help move it faster and better. I'm going to go to Kristen's comment, and I'm going to you, Paul, on this one because you talked a bit about it. What's considered a simple structure? I mean, if you were to explain to the listeners, watchers here, what a straightforward structure would be.
Well, the simplest structure would be everybody had common shares, so everybody having the exact same rights. It's pretty rare that you would find an institutional investor that will come in on that basis. But the next level up is a preferred share that basically gives the institution some additional rights to protect themselves against, as I said before, the potential that the entrepreneur is going to overpay themselves or do things that they ought not do with the company. And often there's a one-time downside liquidation preference, which just means that in a downside scenario, the investor gets their money back out. But in any upside scenario, everybody's sharing equally according to their percentage of the company.
Great. Ron has a question here, which I would say, I could be nice and say you both are examples of it or proof that it doesn't exist. But his question is there such a thing as smart capital? And then he goes on to talk about, is there, similar to Guy Kawasaki, is there a winning equity valuation cash out formulation or something in that realm? Andy, I'll go to you.
Well, I'll take the first one, which is sure, if your definition is smart money is people that can help make a difference, there's a bunch of that out in the industry. Of course, the converse of that is what? Dumb money. There's been comments about plenty of that out there. I think fundamentally, I don't know that I love those terms, but the question is back to where we started at the very top of the hour. What are you looking for? If you want somebody that's going to write a check and talk to you once a year, that's very different than if you really want somebody that's going to help open doors, help you to improve your gross margins, et cetera. And, the latter could be a definition of smart money.
Yeah.
I mean, the last thing you as an entrepreneur need to do is to explain to an investor what slotting is or what deductions are or where freight out goes on a P&L. under GAAP. I mean, that's stuff you may or may not want to take on as an entrepreneur. So having people that get some of that could be streamlining.
Yeah, and I would just say, Ron, I would phrase it more like, what support beyond just capital are you looking for? So it's the support beyond. I'm going to go to Joel. Joel, smart play here. He tried to co-op by compressing like 6 questions into one. So I'm just going to ask a couple, and I'll go to you first, Paul. What is a reasonable expected return rate for an average fund? What are they looking for?
Well, most funds will talk about aiming for 20 to 30% on their entire portfolio. Now, if you actually look what most funds get, it's not in that category. And you have to assume that some things aren't going to work out. And so you look for something a little bit north of that over time. But from our perspective, it also depends on how much risk is in the company. And so we'll accept a slightly lower return if we think that there's a great entrepreneur, there's a good solid plan, they've really thought it through, and they're likely to hit their plan. So it's generalized, but I'd say most funds will go out and sell themselves to their investors as getting between 20 and 30%, even if in fact they don't.
And by the way, that's annualized.
Yeah, and I'm going to give Joel, I'm going to give you one follow-up here out of your 5 that you stuck in here. So again, props to you for doing it. How far, because I think this is a really instructive question for everybody, how far forward, how much runway should the average entrepreneur be looking for as they plan out their capital strategy and come to all of you for money?
Well, I mean, from our perspective, half the time we're told this is the last raise we'll ever do. And that's almost
or more.
But in my mind, it should be at least a minimum of 18 months, but preferably longer than that, because I don't want our CEO out fundraising half the time. I want them building the business.
Okay, go ahead, Andy.
No, I was just going to say, for the earlier stage businesses, at least 18 months. When you get to be maybe 5 million of revenue or more, I'd rather see that you're funded for the duration. You can always decide to accelerate and go further, but you're funded for the duration on sort of a base plan.
Yeah. Mark has an interesting question here. He's developed a raw, organic, vegan, paleo, diabetes-friendly chocolate. I give myself some credit for getting that all out in one breath. The real question he's asking is, he's ready to consider selling this company, which doesn't have a real high income, but has lots of marketing potential. Where does he go to start that process? What does he do?
Well, I'll chime in. I mean, there isn't much of a market. We don't know how big his company is, but there isn't a lot of market for very small CPG companies. So where it's most likely to be acquired is by a small strategic. And I use that term strategic with a small s. Kraft and Mondelez are big buyers in certain categories. Mondelez will be a confections company, but they're not going to buy it. If you look at the really next stage down, there are people like B&G Foods and a bunch of others that have an assorted portfolio. This will be too small for them. There are lots of companies that are $20 million in revenue and $30 million of revenue that would love to add on a really interesting couple $1 million business, but they're of course hard to find. So this is not hire a banker. This is about you doing elbow grease, talking to people that you think this makes sense for. But unfortunately, for our friend that asked the question, there isn't a huge market for a small CPG business.
Yeah, I'd even have conversations with retailers about who might be those partners. Richard has a question for you. Go to you, Paul, on this one, and that is, do most exits for institutional investors, look like a sale, an acquisition?
Well, for us, most of them have, but that's not to say that it needs to be that way. I mean, I think all of our exits have been exiting the entire company along with the founders. But right now we're in a company where it's a nice company. We own a chunk of it in an early fund. It doesn't make sense to sell the whole company right now. And I think that, and we're going to talk to the right people, I hope, to find a buyer for that so that the company doesn't need to sort of engage in a full-on sale. But I'd say in most cases, we're assuming we're selling the company along with the founder.
I'm going to stay with you, Paul, because this is something specific that you brought up. Shannon asked a question around questions. What questions to ask when checking the references on investors?
Okay. So, I mean, I just like basically what people were like to deal with through time, what mistakes you made with that investor, what mistakes that investor made. Did that investor encourage you to do things that you felt ultimately didn't work out for you? When troubled times hit, or how did that investor behave? Were they sort of there with you shoulder to shoulder, or did they become part of the problem? I mean, those are the types of, I mean, it's really just basic common sense relationship questions as far as I'm concerned.
Okay, I'm going to collapse two questions here and go to you, Andy. Both, one from Todd and one from Craig. Nice to see you here, Craig. Todd's question is what's kind of the average exit multiple in the CPG? Is it based on revenue or EBITDA? Craig's question is similar, and that's, can you give us some kind of parameters around what you feel realistic valuation for a traditional better for you CPG brand, like, if sales are 2 million after a couple of years and doubling revenue annually. So just a little bit of talk about, when you're smoking something or when you're being realistic around valuation, or how to think through it.
Yeah, I mean, of course there is no one answer, but everybody likes to cite Burt's Bees and Vitamin Water and Crave and the 10 over 10 years or 10 over 20 years that have been, 5 to 7 times revenue. Those are not normal. Those are awesome, but they're not normal. So if you come in and only cite those, you got a credibility problem. But if you, talk about, a lot of businesses are valued at 1.5 or 2 times revenue, or maybe 3 times revenue. That's a normal range for a $2 million company. Again, you get a lot of benefit, maybe even 4 or higher, but it depends on the business. As you get to scale, I mean, real scale, 20, 50, $100 million, there's a lot more rules, and you start to be a lot more EBITDA multiple based. Now, your EBITDA multiple may look like a 3 or a 4 or 5 times multiple. The idea of you can lose, $50 million and get a 5x revenue, I think those days are largely past. If your business has really attractive gross margins and you're plus or minus break even, maybe that works because you're making a trade-off for 100% growth instead of 50% growth. So the answer is, valuation multiples, I would not bank on more than 3 or 4 in the extreme. And I think, 1.5 or 2 is much more normal. And by the way, the smaller you are, the less the multiples work, because, you put a multiple on a $1 million revenue business or a $500,000 revenue business, and it's not enough to matter.
Yeah, it's not ready for sale. Okay, a lot of complex questions here that we're going to do quick answers to. So apologize to any of you who asked those complex. But Carly has a good one, and I'll go to you, Paul. And what do you think overall about convertible notes and safe notes, and what kind of caps or discounts do you usually see on those?
Yeah, I mean, I don't mind them, as you often see them, especially coming out of, if you're the first sort of institutional round coming in, there's a bit to be factored in. And so as long as they're reasonable, I don't mind them. And the general discount that we see is 20%.
Francisco has a question around good advice or examples of bottoms up Excel approach to fundraising. I think you can finally get some of that from Andy's site. And also, Francisco, I'll just let you know that if you ping me, I'm happy to share some with you. Philip Tevereau, who is one of the great mustaches in the CPG industry, his question is, are institutional investors, and this kind of comes back to an earlier one, interested in exits that may be in the form of like an ESOP? And I'll go to you, Andy.
You know, we actually don't use the phrase exit. We use the phrase monetization. So we're an institutional investor that has third-party investors. It's not all my money. Now, my team and I are unusually large investors in our own fund. So we're eating our own cooking, but we have third-party investors. We have an obligation to return capital to them over some reasonable time horizon. We can't be in a company for 40 years. So we have to have a path to monetization. That could be a full-out sale. It could be, and there are lots of examples. Paul referenced one. There are lots of others where one investor buys another investor stake and the company keeps going. I mean, there was a high-profile one where an Indian company called Tata bought out TSG's 1/3 stake in the company. And then 7 months later, Coke bought the business, and you know, Tata made a fortune. Now, they really wanted to buy the company, but that happens. We have sold a company back to the founder in partnership with a family office. So we are more focused on a path to monetization at some point. You know, we don't create real value in 2 years usually, but it's about a path to monetization. There are lots of ways there. Of course, if you build a great business, a strategic sale may be what is interesting to everybody.
Great. Last question. I'm going to ask one. This is a slightly different turn, so I'm going to go here. Gage has a good question here. And I'll ask this to you both just for a quick response. How much more likely are you to invest in a first-time entrepreneur versus someone in their second or third time period?
Makes no difference to me.
Yeah, I mean, you know, the people that have done businesses before will have largely learned from some of their mistakes. But every entrepreneur I know has made tons of mistakes, including on their third business. So, you know, we've got plenty. There aren't a ton of third-time founders in the same industry. But, you know, it's all about the right business and the right entrepreneur.
Great.
Wow. First of all, Elliot, awesome job. That's a lot of stuff you've synthesized, and you too. Also, I apologize to Bruce Bacon because I hit the wrong button. My comment to your question is, I would be very nervous about engaging with somebody who's not willing to put anything at risk. So I would look elsewhere, or say, look, put something in, and then we can talk. But that people saying they can leverage their expertise and their history, these guys, if they've told you nothing else in the last 90 minutes, it's that it takes a lot more than just expertise to be successful. And look, there's some other wonderful questions in here. Let me say that, again, we've recorded this, and both Andy and Paul have kindly made a lot of resources available, not to mention their own contact information. Elliot has as well. Let me try to hit several key points though, and then ask you guys each for a final, half-a-minute comment. What I heard was, when you're pitching, be clear, be kind to the reader, right? Speak to your audience, don't muck it up, keep it simple. You don't have to, blow them away in the first meeting. You just got to get a little hook in. It's all about fit. Remember, it's a two-way relationship. So I loved the invitation to interview the money, but remember, it's two ways, right? The investors want to know that you, as somebody pitching them, is thinking about them, that you're not just out for yourself. It's a relationship. I loved also get references. Absolutely. You're going into, you're dating here, and you want to find out, what they're like to be in a date with. Raise enough that critical comment, and by the way, I can't do justice to all the key points here, but these ones really jump at me. Be sure you're raising enough so that you're going to add value before you're going to need to raise the next round. That was such a critical point, because I think a lot of entrepreneurs, dilution worry takes over and they cut themselves short and they haven't delivered the value. And again, both these guys have told you they don't want to talk to you again if you fall short. Structure it for both sides to win. I mean, Andy said it multiple ways and times. It's a two-way street. Keep the structure as simple as possible. You know, there's a tendency to, especially nowadays with so much sophisticated money out there, to make these things unwieldy. These are three panelists here who said, no, simple is better. They're going to put a high premium on who you are, on how you're thinking. And they're going to be willing to even take a little bit simpler deal if it's fair to both. So I tried to do justice to your key points, but Paul, any last comment from you?
No, I mean, I guess at one level, just ask yourself, do I like this person? And do I want to have to talk to them for the next 5 years?
Right. It's a marriage. Andy?
Yeah, well said, Paul. I mean, at the end of the day, this is about trying to get where you're wanting to go. If you're clear on where you want to go, you're more likely to find it. And finding an investor or multiple investors that fit what you're looking for is really important, because there's nothing worse than being in a bad business marriage, except probably being in a bad real marriage. So, you know, focus on what it is you really want and let that be your North Star as it comes to funding.
Yeah. Elliot?
I think really quickly, really simply, I mean, investors invest. That's what they do. So the question is, why should they invest in you? And why do you want them to invest in you? And
Yeah.
you need to know the answers to both.
Yeah, well said. All right, Carlene, thank you, everybody. Carlene, can you put up our closing slide? Again, I want to remind everybody, first, New Hope, this is brought to you by New Hope Network. We want to thank them again for the partnership. Next week, we will be talking to Costco and Thrive. We do have a webinar set up for the 31st. I'm just waiting on final confirmation with a couple of really exciting retail partners, so you'll want to attend. And we will go into April. We're working on a very interesting one for the first week of April. Just stay tuned. Another reminder, you will see probably next week our announcement for May 5th through 7th. All three of our presenters today will be part of the Hirshberg Entrepreneurship Institute. First 2 days are on finance, cash flow, not surprisingly, properly valuing. We have some legendary storytellers who will be with us. The second day is branding, marketing, positioning, e-com. Third day is your day to pitch. So we'll see what you've learned from our panelists today. We've got slots for 13 different people to pitch, and you'll have an opportunity to apply with your pitch application. I remind you, we had a wonderful service offered by Manoli at the beginning. I agree with Andy. It was a wow. Really interesting. You ought to take him up on it. If you have a 5-minute product or service you want to offer to the HEI community, get it into Carlene on our website, and we'll get you in at the beginning of our next couple of one of our next webinars. So we will continue through April. Again, as ever, your feedback, topics, your evaluations, all crucial to helping us keep offering this service. Paul, Andy, Elliot, you guys were awesome. I'm going to go back and look at the recording myself. My pen couldn't keep up with you, but thank you for a great session, everybody, and stay safe, and we'll see you in a week. Bye all.